Welcome back to TalkTickers.
Great to be here.
Today, we're doing a deep dive into the Glimpse Group's Q3 Fiscal Year 2025 earnings call.
That's right. Just happened recently.
Our mission, as always, is to pull out the really key insights, understand the performance, and get a handle on their outlook based on what management shared.
Yeah, there's a lot packed in there. Management definitely painted a picture focused on what they see coming just around the corner. A big shift expected.
Okay, so let's start with the basics. The quarter itself, Q3 FY25, ended March 31st. What were the headline numbers?
So top line revenue came in at roughly $1.4 million.
$1.4 million.
Okay.
How does that stack up against last year?
Well, that's where you see a drop. Q3 last year, FY24, was about $1.9 million. So yeah, it's down around 25%.
25%. That's pretty significant quarter over quarter. Did they explain that dip?
They did. They said it was expected, actually, something they'd flagged before. It's mainly down to revenue recognition timing, when exactly large contracts hit the books.
Ah, okay. So timing issues, not necessarily a slump in underlying business activity during the quarter itself. Makes sense. How did the 9-month picture look then? Smoothing things out a bit.
For the first 9 months of fiscal 25, revenue was about $7 million.
Okay, $7 million. And compared to last year?
That's the interesting part. It was essentially flat compared to the same 9 months in FY24.
Flat. But didn't they sell off or consolidate some businesses?
Exactly. That's what's pretty remarkable. They divested and consolidated subsidiaries, yet the year-to-date revenue held steady. It suggests the remaining core businesses are performing well.
That's a really crucial point. A smaller, more focused company maintaining the same revenue level. Okay, let's talk cash flow. Always important, especially for companies like this. How did Q3 look on that front?
This was a real highlight, they stressed. Operating cash flow for Q3 was positive, about $0.13 million in the black.
Positive operating cash flow.
Nice.
And what's more, it was the second quarter in a row of positive cash flow from operations. Oh, wow. 2 quarters running. That definitely suggests a trend, not just a one-off.
Absolutely. And look at the 9-month comparison. For the 9 months ending March 31st, FY25, the operating cash loss was tiny, only about $0.13 million. Basically break even.
Okay.
Now compare that to the same period last year, FY24, where the operating cash loss was around $4.3 million.
Whoa. Okay, that's a massive swing from burning over $4 million in 9 months last year to essentially break even this year on similar revenue.
Exactly. It points to some serious improvements in operational efficiency, getting much more out of their revenue dollar.
Definitely. So where does that leave their balance sheet? Cash on hand.
As of March 31st, they had about $7 million in cash and equivalents, plus about $0.65 million in accounts receivable.
Solid cash position.
And importantly, they made a point of saying the capital structure is clean. No debt, no convertible debt, no preferred equity.
Good. Strong cash, improving cash flow, clean cap structure. Okay, that sets the stage nicely. But the real focus of the call, it sounds like, was looking forward. The guidance for Q4 and the full year.
Right, that's where things got really interesting. The whole tone shifted. For Q4 FY25, the quarter ending June 30th, they're guiding for revenue between $3.2 and $3.8 million.
Hang on, $3.2 to $3.8 million. In 1 quarter, we just said Q3 was $1.4 million. Well, that's more than double.
Yeah, it's a huge projected jump.
What's driving that massive acceleration they're forecasting?
It's tied very specifically to the expected delivery and, crucially, the full revenue recognition of the final stage of a large Department of Defense contract.
That big DOD deal.
Exactly. And they also explicitly said they expect to be profitable in Q4.
Profitable too. So that single DOD contract completion is expected to drive a huge revenue quarter and push them into profitability. What does this Q4 surge mean for the full fiscal year then?
Pulling it all together, for the full fiscal year 2025 ending June 30th, they're guiding for total revenue between $10 and $11 million.
Okay, $10 to $11 million for the year.
Which represents a projected increase of 15% to 25% compared to fiscal year 2024. And again, that's despite those subsidiary divestitures and consolidations during the year.
So after being flat for 9 months, they expect this massive Q4 to pull the whole year into solid double-digit growth. That's quite a forecast. What's the engine behind all this? What are they pinning these hopes on?
One thing came through loud and clear: Spatial Core. That's the driver.
Spatial Core.
Right.
Remind us what that is again.
They describe it as basically an operating system for spatial computing. Think of it as a software platform that integrates complex data, AI, into these rich 3D environments.
All right.
It allows for things like cloud compute, running really complex simulations, and generating insights from real-world data but displayed and manipulated in 3D space.
So it's not just making things look 3D, it's making those 3D environments intelligent and useful for complex tasks.
Precisely. They talked about applications in robotics, drones, digital twins. The CEO actually used the phrase, supercharging big data, making big data useful and actionable in these advanced 3D settings. They stressed it's being used now, especially by the DOD.
Sounds like that's really the core of their strategy going forward. Did they give any specific updates on Spatial Core's progress, recent wins or milestones?
Yeah, several key things. First, Blightline Interactive, that's the subsidiary focused on Spatial Core, is expected to deliver that final stage of the big $4+ million DOD contract this month, May 2025.
This month. Okay, so that's the immediate catalyst for the Q4 guidance.
Exactly. Second, they successfully delivered their first full-motion immersive simulator system to the U.S. Navy in Q3. They see that as paving the way for potential follow-on deals.
Good progress with the Navy. Anything else?
Yes, they also mentioned getting official confirmation just last week for a new 7-figure Spatial Core deal. They expect it to be signed very soon in the coming weeks.
Wow. Okay, so concrete, near-term stuff. A multi-million-dollar delivery hitting the books now, a successful Navy deployment, opening doors, and a new big deal, basically confirmed and about to be signed. That's tangible.
Definitely feels that way. And while Spatial Core was the star, they did mention other parts of the business are moving forward too.
Like what?
Portel Reality signed contracts for its AI training product. Sector 5 Digital got follow-on deals with big names like Halliburton, Walmart, AT&T. Glimpse Lens apparently had strong quarter-over-quarter growth in Snap revenues. And Glimpse Learning got new software license deals in healthcare and education.
Okay, so Spatial Core is the main engine, but the other pieces are still contributing. Let's circle back to that cash flow turnaround. You said from burning millions to positive. How did they explain achieving that?
It comes down to a few things they executed on. The big reorganization they did, serious cost control efforts, those are paying off.
Right, cutting costs.
Plus, maintaining really high gross margins. Q3 margin was around 72%.
72%, that's very high.
Yeah. And they actually expect forward gross margins to be in the 65-75% range, maybe even improving slightly because more revenue is coming from Spatial Core and software licenses, which carry those higher margins.
So cost cuts plus a shift towards higher margin products, that explains the cash flow swing. Makes sense.
Did they update on adjusted EBITDA as well?
They did. Adjusted EBITDA loss in Q3 FY25 was about $1 million, slightly higher loss than Q3 last year, which they tied to the lower revenue recognized in this Q3.
Okay.
But, echoing the revenue and profit guidance, they expect adjusted EBITDA to be positive in Q4.
Positive EBITDA in Q4.
Right. And for the 9 months, the loss was about $1.2 million. That's a big improvement from the $3.5 million loss in the same period last year. So putting it all together, they think the full fiscal year 2025 adjusted EBITDA will end up slightly negative, but way better than the $4.6 million loss in FY24.
Okay, another metric showing that clear improvement trend towards breaking even or better. So let's synthesize this. What's the bottom line here for you, the listener, thinking about this company as an investor? Well, this coming Q4 and the full year results for FY25 seem absolutely critical. It's potentially a real pivot point based on their guidance.
Because of that huge guided revenue jump and the shift to profitability.
Exactly. And it's tied to very specific named events, primarily that big DOD contract delivery. Plus, that consistent positive operating cash flow is a really strong signal. It shows the operational changes they made weren't just talk. They're actually much more efficient now.
Yeah, that cash flow turnaround, especially with flat year-to-date revenue despite the portfolio changes, is quite telling. They seem much leaner, more effective.
Agreed. And the strategic bet on Spatial Core looks like it's starting to pay off with real contracts in demanding sectors like defense. It positions them right in that intersection of spatial computing, AI, 3D data, potentially a very hot space.
Do they mention any potential roadblocks, headwinds?
They did bring up the U.S. government budget situation, the continuing resolution, the lack of a full FY25 federal budget. They said it has delayed awards for some government and DOD opportunities they're chasing.
Ah, the dreaded DC budget delays.
Yeah, but they sounded confident that they're well positioned for those deals, including some potential 7-figure ones, once the funding situation gets resolved in the coming months.
Okay, so an acknowledged external risk. But they believe the pipeline is solid. How does management feel about their stock price, given all this?
They were pretty blunt about it. Said they see a sharp disconnect between what they believe the company's intrinsic value is and where the stock is trading, both on its own and compared to peers in the spatial computing and AI world.
An explicit, we think we're undervalued statement. Any hints about acting on that?
They brought up their existing $2 million share buyback plan, which is currently untapped. They said they might look to use it if needed, suggesting it's a tool they could deploy to support the stock value.
Interesting. Belief in their value, catalysts lined up, better financials, a potential buyback. Seems like management thinks they're at an inflection point. Okay, time to switch gears completely. Let's do our not financial advice segment, purely hypothetical, remember. Imagine you're an analyst pitching a trade idea to your hedge fund's investment committee based only on this earnings call.
All right, pitch mode engaged.
Okay, team, listen up. Glimpse Group's Q3 call just dropped some potentially explosive near-term catalysts. They're guiding Q4 revenue to more than double Q3. Think $3.2 to $3.8 million and flip to profitability. Why? Because a $4 million plus DOD contract is landing this month.
Plus that new seven-figure deal confirmed, expected to sign soon.
Right. And management explicitly calls out a sharp disconnect in valuation and dangles a $2 million buyback.
So the catalysts are clear, big, and immediate.
Exactly. The trade idea. A hyper-focused, event-driven long position targeting the Q4 earnings release. Go long now betting they nail that Q4 guidance.
Okay, where's the outrageous part?
The outrageous part is the timing and dependency. You're betting heavily on the flawless, on-time delivery and revenue recognition of a large, complex government contract right now, despite those background budget uncertainties they mentioned. You need that new deal to sign quickly to add momentum. And you're assuming management actually uses the buyback effectively to put a floor under the stock, just as these catalysts hit.
So it needs like perfect execution on multiple fronts simultaneously, plus a receptive market. Very high risk on timing.
Very high risk.
Oh.
But the plausible part? The company does seem operationally transformed. That cash flow turnaround isn't smoke and mirrors. Management sounds genuinely confident about Spatial Core. If they do deliver that monster Q4, especially near the high end, the numbers are so dramatically different. The growth, the profitability could absolutely force a market re-rating, especially with management priming the pump about being undervalued.
It's a pure bet on near-term execution hitting stated targets, amplified by the valuation commentary. High risk, potentially high reward if they deliver exactly as guided.
Precisely. It's totally speculative, based only on the call, and definitely not financial advice for anyone listening. Betting on government contract timing is tricky. All right, let's wrap up this deep dive on the Glimpse Group's Q3 call. Key takeaways. Number one has to be that strong guidance for Q4 and the full fiscal year. Big revenue growth expected, turn to profitability.
Yeah, driven mainly by Spatial Core hitting key delivery milestones. And number two, that dramatic improvement in operational cash flow. 2 positive quarters, near break-even year-to-date after burning millions last year. That shows real change.
Plus, they're doing this with a solid cash balance and a clean balance sheet. No debt is always nice to see.
And that strategic focus on Spatial Core seems less like a future dream and more like a present reality with tangible contracts. Although, as they noted, the overall government spending environment is still something to keep an eye on.
Definitely. And just to reiterate, everything discussed today comes from our analysis of the earnings call. It's for informational purposes, definitely not financial advice.
Yeah, as you think about this, maybe consider how much weight you give management guidance tied to specific large contracts versus the inherent execution risk. That really feels like the core tension here.